Macroeconomic uncertainty, policy uncertainty, those two things may feel more pronounced today, but they're really always there. And our ability to predict the outcome on those things is also not something we want to rely on as a steady source of our investment performance. What we want to rely on is trying to understand what is the total range of outcomes. What we do in the context of the portfolios we manage is we try to dial up and down our risk. When valuations are quite high, we try to be a bit more conservative, and when valuations are depressed, we try to be more aggressive. That's obviously counter to the crowd, and that's counter to human instinct, and we try to maintain that discipline throughout what we do. I think there's a tendency for investors to predict the end of a cycle more frequently than those cycles actually end. When generic credit markets don't offer attractive value investment opportunities, we try to look in other places to generate attractive risk-reward opportunities. And so that means looking across different, less understood asset classes, oftentimes in areas of complexity or areas of illiquidity or areas that include significantly more process than a typical credit investment. But we're never going to be able to predict the future. We can only plan for eventual outcomes and try to assess the probability and try to assess the risk-reward across that spectrum of outcomes.